very on to the channel. Today, we re-diving deep into a topic that is both fascinating and crucial for anyone serious about options trading. Understanding the dynamics of the volatility surface, especially when it comes to American options. It might sound complex, but I promise we'll break it down step by step. So, grab your coffee and let's get started. First things first, what exactly is a volatility surface? Imagine a 3D graph. On one axis, you have the strike price of an option. On another, you have the time to expiration. And on the vertical axis, you have the implied volatility. This 3D landscape is what we call the volatility surface. It is a powerful visual tool that shows us the implied volatility for a whole range of options on the same underlying asset, all at a single point in time. Essentially, it's the market's collective forecast of future price swings. Now, you might be thinking, where does this implied volatility even come from? This is where the famous Black-Scholes model comes into play. While the original model assumes constant volatility, which we know isn't true in the real world, it gives us a framework to work backward. We can take the current market price of an option and plug it into the Black-Scholes formula. The one variable we don't know is volatility. By solving for it, we get what's called implied volatility. It's implied because it's the volatility level that the market price is implying. When we do this for a ton of different options with various strikes and maturities, we can plot them all out and create our volatility surface. So, what makes this surface move and change shape? Two main drivers are at play: supply and demand, and broader market sentiment. If a lot of traders suddenly want to buy puts to protect their portfolios, the demand for those options will drive up their prices. A higher price, in turn, means a higher implied volatility for those specific options, creating a bulge or a skew in our surface. Similarly, major economic news or a general feeling of uncertainty can cause the entire surface to rise, as investors expect more turbulence ahead. In contrast, a calm, bullish market might see the overall surface flatten out. Observing these shapes, like the volatility smile or smirk, can give us incredible insights into market expectations. Now, let's add another layer of complexity: American options. Unlike European options, which can only be exercised at expiration, American options can be exercised at any point before the expiration date. This right of early exercise is a game changer, and it has a significant impact on how we model their volatility. Why? Because the possibility of exercising early has value. This early exercise premium means an American option will almost always be worth at least as much as, and often more than, its European counterpart. This added value complicates things for our volatility surface. The standard Black-Scholes model was designed for European options to accurately price American options and derive their implied volatilities. We need more advanced models, like the binomial tree model or other numerical methods. These models have to account for the optimal time to exercise, which depends on things like interest rates and dividends. Because of this early exercise feature, the volatility surface for American options can look different from that of European options, especially for options that are deep in the money. The holder of a deep, in-the-money American call on a stock paying a large dividend might find it optimal to exercise early to capture that dividend. This behavior is priced into the option and therefore reflected in its implied volatility and the overall shape of the surface. So, when you're analyzing the volatility surface for an asset, it's absolutely critical to know whether you're dealing with American or European style options. To wrap it all up, the volatility surface is a dynamic map of market expectations. The Black-Scholes model provides the foundational tool to calculate the implied volatility that builds this map. But when we step into the world of American options, the right of early exercise adds a new dimension, requiring more sophisticated models to truly understand the landscape. By learning to read these surfaces, you're not just looking at numbers. You're gaining a deeper understanding of market psychology and potential future movements. I hope this breakdown was helpful. It's a dense topic, so feel free to rewatch parts or drop your questions in the comments below. I love hearing from you all. If you found value in this video, please hit that like button and subscribe for more content just like this. Thanks for watching, and I'll see you in the next one.